Well, good morning, everybody. Welcome to InPlay Oil's presentation. I'm Doug Bartoli, President and CEO of InPlay Oil. So we're a Calgary-based oil and gas company focused on light oil in the Western Canadian Sedimentary Basin. We've had a hell of a couple of years in our industry, and the good thing is we've performed well. We've been one of the best performing oil and gas stocks in the Toronto Stock Exchange in the last year. And things continue to look strong for our industry, as I believe we're in a multi-year oil bull cycle. With that said, I'm going to jump right into the presentation and talk about the investment highlights and the recent events. But we're a very technically focused team. I'm an engineer by trade. We've made the right moves in 2020 during the COVID demand destruction that occurred in the low oil prices, and some great moves in 2021. We've been a continued top-tier organic or drill bit growth player in our industry amongst our peers, and we are now in the best financial and operating position in our history. The moves we did made us very, very sustainable. 21 was a record year for us in financial operations and reserves. We had record production. That was 45% growth over 2020, but more importantly, 15% growth over 2019, which was our prior year. So we came out of the pandemic destruction magnificently. 47 million in funds flow. The prior year, the best year, was 32.5 million. Big growth in those time frames, and record low debt and dropping rapidly is what's occurring here. So our guidance for this year, the midpoint of our guidance is 9,150 BOEs a day, a little over 60% light oil and natural gas liquids. Our funds flow right now on a $90 WTI price is over our range is 141 to 150 million dollars Canadian, so just about 3 times what we did in 2019. And our free adjusted funds flow are north of $80 million, which again is magnificent. Basically puts us debt-free by the end of 2022. Just a quick summary. We talked about our guidance. We're going to drill about 17 extended reach horizontal wells, so typically 1.5 to 2 mile horizontal wells in our play. Our reserves, we had a spectacular year in all 3 categories, 16 million on a proved developed producing basis, all the way up to 60 million on a proved plus probable basis. 86.5 million shares outstanding, gives us a market cap of about 300 million. At 347, we currently hit our recent highs this week at 450, which puts us closer to $400 million market cap and a $480 million enterprise value. Our liquidity has tripled in the last year from where it used to be. So again, lots of eyes, lots of people moving into our stock. We own 7.2% as employees and directors, and we have one large inside shareholder who is represented on the board at 22.5%. We ended the year with 79 million drawn and 80 million of net debt, and as I mentioned, with our free funds flow of north of 80 million, puts us in a debt-free position by the end of the year. 2021, everything we circled there is records for us. Production record, funds flow record, funds flow per share record at 67 cents a share. First time we had free adjusted funds flow that was working towards paying down debt of just under $14 million. Revenue per barrel, operating netback at $35 a barrel. Operating expenses come down every year. They came down 11% from 2020 and 21. And our net debt was the lowest ever as well. All of our management team, our directors, bios are on our website, on our presentation in the back. Strong technical team. The director is very experienced in the Canadian oil and gas industry. Craig Golanowski is our chairman. He's the representation for the 22.5% of our shareholders. But very knowledgeable, did a great job helping us through the demand destruction that occurred in the pandemic. So this is my favorite slide. You got 4 charts here. If you take a look at the top left-hand corner, that's our production growth since we went public in November of 2016. The light green is light oil and our natural gas liquids, with the orange being gas. The blue squares are production per share growth over our history of being public. Now, 16 was a stub year, so it doesn't really matter. But if you look 17, 18, 19, we were growing every year on a production per share basis. And I've always said, if you are growing production per share and reserves per share, you should be creating strong value for your shareholders. Now, of course, we have the ups and downs in pricing, which have been down most of that time, but not today. So how does that relate? Well, let's go to the reserve side too. Same thing, our reserves. All three categories were growing every year through that whole time frame, with acceleration in reserves growth, adding to our sustainability in 2020 and 21 with the moves we've made. If you go to the bottom left-hand corner, how does that relate to our cash flow, our funds flow? Well, it's the same thing. We were growing our funds flow every year in 17, 18, and 19. And our funds flow per share was going up every year. In 2020 came, very difficult year, but the moves we started to make in 2020 actually set us up to be even a better and more sustainable company than we were prior to the COVID pandemic. As much as it was painful, it was actually came out of the back end in much better shape than we ever thought we would be in. And you could see the production or the funds flow per share growth on the green. 47 million, as we mentioned, in 20, working our way north of 140 million in 2022. Bottom right corner, running a pretty good company through a tough time in 17, 18, and 19. We're dropping our leverage every year, 1.9 debt to EBITDA in 2017, 1.8 in 18, 1.6 in 19. And now it's like falling off a cliff. We were at 1.5 in 21, and with the free funds flow working our way basically to zero leverage by the end of this year. Our year-end reserve highlights: proved developed producing reserves, total proved plus probable. What I really want to talk about is the reserve replacement here, 395% in PDP, total proved over 1,200%, proved plus probable 1,400%. But back to the sustainability, our reserve life increased huge. 7.5 years on a proved developed producing case. So that's a straight blowdown of our current producing reserves. 22 years we've now moved to in a total proved case, and just about 29 years in a proved plus probable case. So total proved is about a P90 chance from our reserve evaluators of hitting that number. Proved plus probable is about a P50 of hitting it either way. If you take a look at what we're finding these reserves for, you can see in the bottom there, $8.50 for a proved developed producing, $12 for total proved, $9.50 for proved plus probable. The recycle ratio is just dividing your net back divided by the acquisition cost that I just mentioned. Anything over 2 is magnificent, but we're at the high end of our peer group. And I have some of our light oil peer groups on the right, and you can see their finding costs compared to ours and their recycle ratios. We are at the top of our peer group in adding reserves. We have a very, very good play in Canada. And again, we're providing top-tier efficiencies, finding reserves and adding producing barrels. Top left corner is 2019. That's us. Our number 2 is finding proved developed producing reserves and our recycle ratios. In 19, on a total proved basis, the bottom left, we were number 1. In 2020, there was a lot less people that were actually able to show decent reserves finding costs due to the demand destruction, the lack of capital being spent, and the very, very poor pricing used in the reserve report at the end of the year. But we were number 1 and number 2 amongst my Canadian peers in 2020. And 21, same thing. Number 2, top right corner on PDP, number 3 on a total proved basis. So head office is in Calgary, Alberta. Our field is mostly Cardium. 80% of our production is Cardium, so that's the field we're in, or the play we're in. And we're in the Pembina and Willesden Green fields, which is about a 2.5-hour drive northwest of Calgary. We're in the old oil patch. The fields were initially found in the 50s and 60s, delineated with vertical wells in the 70s and 80s, put under water flood. We are now drilling deeper and off to the halos, off to the sides of these, using horizontal well multi-frac completion technology. So how do we get top-tier growth and with our sustainability? How does that occur? Well, it's because we have low base decline production. We have high netback oil production, and we've got quick payouts At today's prices, we're currently paying most of our drills out within about 3 months on a drill, complete, and equipment tie-in basis. Willesden Green. We have a dominant land position in the Willesden Green area. We've got a lot of low-risk infill drilling. Now, we did an acquisition. Most of the production, or most of the yellow lands you see in the bottom, was an acquisition that just closed at the end of November in 2021. It doubled our land holdings. It increased our inventory of drills by over 90%. Lots of contiguous land so we can continue to drill extended reach horizontal wells. Low base decline when we took this over. They had not drilled a well in here since 2018. We've already drilled 4, and by the end of this quarter we should have another 2 or 3 drilled in this play. It was accretive on just about every metric you want it to be accretive on. That deal was done at $1.20 a share, and we're currently around $4.50 here today. So some very happy people that joined our shareholder list when we did a bought deal to close this deal. Pembina. We did an acquisition in October of 2020. Oil was $40 to $45 through that time frame. It's in the bottom left corner of there where we did this acquisition. That acquisition, we were able to convince our lenders in a very difficult time to do that acquisition. There was no dilution to our shareholders when we did that acquisition. And again, believe me, that was difficult to get them to put money out in that time frame. That asset was under 300 BOEs, barrel of oil equivalent per day at the time. It's now north of 3,000 barrels of oil equivalent a day. So that was a phenomenal deal. And in fact, the $1.9 million we paid for that asset, the first 6 wells, the complete battery, the facility that we built there, all paid out within about 10 months of the time that we started drilling on it. The Cardium type curves. The Cardium, it's a well-established play providing some of the best low-risk returns in the Western Canadian Sedimentary Basin. Now these are different wells, 1.5 mile wells, mostly what we're drilling, but we're mostly drilling 1.5 miles. But let's just focus on one for simplicity. The Pembina 1.5 mile horizontal well. It's about $3.1 million to drill, complete, equip, and tie in. At $80 a barrel, this is paying out in about 0.5 or 6 months, 0.5 a year or 6 months. And it's about 0.4 of a year at $90 a barrel. The other piece to that whole equation is we're actually exceeding the type curves on just about most of these bases, hence why we're getting payouts in about 3 months. Very similar economics with the rest of our drilling throughout the play. Our 22 forecast. Right now we have $90 WTI. Strip is quite a bit higher than that. That gets us about $109, $110 Canadian at the wellhead. We have a bit of a discrepancy that we've never seen before. Usually when we get to $100, $90, $100 WTI, the Canadian dollar is very close to being on par with the US dollar, but it's not currently. It's 80 cents or under 80 cents. So we're getting a massive, massive bump with what we're actually getting at the wellhead. I mean, back in 2014, when WTI was $100 and went over $100, our dollar was on par or even stronger than the US dollar at the time, which had us at $100 WTI, getting us the low 90s at the wellhead. We're having a complete different effect this time around, and it's really, really helping with our funds flow. So at the mid-range of our guidance, 9,150 BOEs a day, we're going to get an operating netback at $90 WTI of kind of in the mid to high $40 per BOE. That provides north of $140 million of funds flow, so just about 3 times more than what we did in 2020. Capital program is just under $60 million, drilling 17 wells. Free funds flow between 83 and 92 million there. Our free funds flow yield, when we put this presentation out, our March presentation, was about 31 to 35%. Today it's more like 25 to 30 as our stock price has continued to move up. Positive working capital, actually positive net debt, if you can actually wrap your head around that, because we do have a term loan that's due at the end of November in 2024, which will have that all of that cash plus some in the bank by the end of the year. And again, basically no leverage as we move forward. couple of different looking metrics. I mean, our forecast is $90 WTI. At $100 WTI, we gain another 8-9% of funds flow to $156 million. Increasing our positive working capital as we get to the end of the year, and for even the stronger bulls, you can see what $110 WTI does, pushing us over $160 million in funds flow. So I mean, this free funds flow, it's going to be used to enhance our corporate sustainability by reducing debt. We want to continue to transact on accretive acquisitions and continue to provide top-tier returns to our shareholders. When you take a look at net asset value, so it's just your different reserve categories. I'll use the total proved case in the middle, 471 million, some undeveloped land, year-end net debt. That gets us to $4.92 a share. When you take a look at the 2020 net asset value per share, if with no debt, which is we're working to at the end of the year, it starts bumping that up to, what is that? I think it's $5.92 per share. The other piece with this reserve evaluators at the end of the year, they were actually, in the first 2 years, north of 20% lower than where strip pricing is here today. So there's lots of upside in those reserves if you take a look at the future pricing. On the environmental side, I mean, our inaugural sustainability report is going to be released this summer. Our Scope 1 and Scope 2 GHG CO2 emissions reduction has been spectacular every year except for 2020, with less capital going on and less growth and everything else. But it's back to 20% we did in 2021, and we expect to continue to be able to reduce those greenhouse gas emissions at least by that number as we move forward. In our liability, our asset retirement obligations, last year we abandoned 75 wells. We reclaimed 22 sites, and again, similar type numbers this year and every year moving forward. So we're deep value. As I mentioned, we are one of the best performing stocks in the Toronto Stock Exchange in oil and gas in 2021, and we're having a pretty good start to this year as well. If you take a look, this is one of our analysts from 8 Capital, Phil Skolnick out of New York, and this is his peer groups and us in there. So we're in red. If you take a look at the left side, he's showing on the bottom total debt adjusted returns. We're at the high end of that. And if you take a look at where we stand on a cash flow multiple, enterprise value divided by debt adjusted cash flow multiple, we're around 1 times on his price deck. Now again, our price has moved up, but it's the relativity. Most of the companies have moved up. We are still low value or deep value and some of the best returns out there. If you take a look at the right side, we have that plotted against the debt to cash flow. And again, we are one of the bottom third leverage companies within his peer group and one of the lowest trading multiples right now. So our industry the whole industry is trading nowhere near what it used to in the prior years to the COVID demand destruction. The industry is on average maybe 3 to 4 times cash flow multiples. In the old days, you could easily trade 6 to 7, 8, 9 times. So the whole industry is undervalued, and yet we are still deep value as well, including top tier growth amongst our peers. So in summary, we're a team that's executing on a strategy, providing top tier production growth, strong free funds flow, focused on maximizing returns to the shareholders. The latest acquisitions we did improved our long-term sustainability. There were low base declines, minimal capital to keep this production flat, significant addition, top-tier operated high working interest inventory. Our forecast speaks for itself, triple what we did in funds flow from 2021, zero debt, and 85 to 90% debt-adjusted production per share growth. Again, all of these top decile of our light oil peers in Canada. We are positioned well with our balance sheet, with our workings with our lenders to do more accretive, disciplined acquisitions. We have a best-in-class operational and technical team. We've been driving our costs lower. We continue to add significant efficiencies into finding reserves and adding production. And you know what? I believe being capital efficient is one of the keys to being a leader and to being successful in our industry as it sits today. With that said, I'm done here and I'm open for questions. So, I'm supposed to re-ask the question so that the people on listening can hear. So the first question is about, just talk about return of capital to shareholders, and second is about the acquisitions and the environment. So, I mean, as far as returning capital to shareholders, look, I mean, we have strong free funds flow. The industry has gone to talking about free funds flow, free cash flow. And being disciplined. Bay Street, Wall Street are no longer looking for growth's sake. That seems to be a common theme. And access to capital, both debt and equity, isn't as easy as it used to be. So I completely love the way we're running our business. It's so much easier running your business like this. Before, you know, in a high price environment, if you spend all of your cash flow on drilling, you get declines that are 40, 45%. Then oil goes back down to $60. Guess what? You don't have enough cash flow to stay flat anymore. So it's a much better, sensible way to run the business and for the industry to run their business. You know, with that said, we're providing top-tier production growth and having solid free cash flow. Ultimately, you know, what are we going to do with that free cash flow? Three things really. There's acquisitions, there's return to shareholders through dividends, and potentially share buybacks. All of those options are on the table and will be looked at in the upcoming months as we move forward. But you know, that's just where we're going to sit, and we're going to have to you know, do a deep dive into ways to return to the shareholders. So they're all on the table. As far as acquisitions go, so I mean, we were able to get some great acquisitions done, you know, in 20 and 21. There are opportunities out there. Now, we haven't seen a lot right now, you know, and I think it's just going to be a little bit of give and take of what our expectations are between the buyers and sellers. What pricing do you want to use? Because, again, you know, it's very volatile. I mean, you're not going to use $100. You're not even going to use $90. You got to look at the future strips, which gets into the $80 and you know, further down into the $70 range. You got to try and figure out what's going to be the matching piece between the buyers and sellers. But I do believe there's still that opportunity. I don't see hugely multiples being part of the acquisition piece, but it'll have some higher pricing in there. So it's going to take a little bit of time to figure out. There are you know, lots of things for sale right now, lots of assets, some companies for sale. But very, very slow in getting these deals done. And again, part of the problem is lack of access to debt specifically. The lenders have not returned to how they were lending prior to the COVID pandemic. And even equity isn't as abundant as it used to. So again, there's certain people that can do it, and there's certain people that probably can't do it. And we've shown last year that we were able to get both of those things done to get a very, very strong deal done. Yeah.
Can you talk about drilling contractors that you use? Do you use a specific contractor for most of the new wells, or one minute, or a few of them that you might mention, and in particular, other companies?
So, yeah, drilling contractors or you know, completions, I guess, go into the same category. But bottom line is we typically use private companies. In our area that are focused on our play. We have strong relationships with people. You know, our view of things is we want good crews, good equipment. We've never nickeled and dimed to the lowest levels when things were bad, but we also want the loyalty and, you know, don't want to be paying the highest levels as things go up, which currently are. But you know, there's lots of issues on the service side of the industry, and I mean that's you know, one of the issues that's going to keep us from, as an industry, showing huge growth is the lack of people. People have left the service side. They're not coming back in abundance. There's all sorts of supply chain management issues that are part of what's going to keep production lower for a longer period of time, which again ultimately is providing what I believe to be a multi-year oil bull cycle. I'll be around. Please feel free to track me down, and if you have any questions, let me know. Thank you very much.